What was I gonna say? Yeah, so I mean, some of the banks aren't exactly international players, right? And I'm talking
Mhm.
about a bank that is an international player, so that already narrows down the possibilities. So
Uh,
I mean, again, like I'm trying to just what do you say? What do you say? Like protect the innocent by not naming them, but I mean, unfortunately, there's just not very many banks, so I mean, it's not very anonymizing, right? People can figure it out. I can't do anything about that.
yeah, yeah, I get it. It's like, so what actually happens in a quant fund? Like, how do you come from ideation process and take that idea thing? Like, how do you test it and like and consider like, is it worth something? Like, is it does it work or not? I mean, how is the whole process?
Okay, so I worked at a sell side quant, right? So I didn't have that much creative freedom on that side of the product generation, but I mean I know kind of how it works.
Okay.
I have to give like again like this goes back to the I have to give examples of where I worked
Yeah,
because I
yeah.
don't know anything, right? And if you interview other quants, they will have could have like completely different experience because especially if they work on the buy side, right? I work on the sell side.
Uh-huh.
So, so at this bank, basically the focus was on consumer wealth management products, all right?
Mhm.
So what they do, like, if you ever like walk into a bank and said like you wanted like a market linked debt like instrument, right? I mean, you don't use those words, but like that's what they give you, right? Like they give you like a high yield product, right?
Mhm.
That's like linked somehow to the stock market, and you get your yield, your higher yield than investing in treasuries, right?
Mhm.
And the way they do that, and this is like an open secret in the industry, but
Mhm.
the people that we sell to don't really know. It basically structurally is just selling puts on the stock market,
Mhm.
right? So you know what put options are?
Yeah, 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 I do.
Okay, so I mean, you get the premium, right? And I mean, you could go out to the market and do it yourself, right? And save yourself the banking fees and so forth, right? But I mean, you still need you need the day-to-day risk management, which most people aren't able to do. So the bank does it for you, right? And they take a fee on that,
Yeah, huh. Okay.
base, right? And I mean, there's because the stock market is usually bullish. Um, this product usually works well, right? I mean, so and that's why like the banks are addicted to this, all right? It's every time and they made the feature. So basically, like they are called the industry standard term is called an auto callable reverse convertible,
Mhm.
right? So the reverse convertible part, I mean, it is basically referring to like a selling a put. All right. Now you don't use that language when talking to the clients, right? Selling puts are so risky and stuff like that. What the way the language is pitched as, right? The product is pitched as is well, when the stock market, when you're at risk, when the stock market goes down and the puts that you sold are in the money, right?
Yeah.
Well, you actually, you must so those put, you make, then because you sold the puts, right, you lose some money, right? You lose money off your principal, right?
Yeah.
From the point of view of the investor, right? So what they say is that you are actually buying the assets. Um, you're long the asset, right? Because you're selling the put, so you're long,
Yeah. Yeah.
structurally long,
Yeah.
right? So
Yeah.
that's what they pitch it as, except that you get a bad price for the buy, but they don't value that, right? They
Yeah.
don't say that, although that's implied in the formulas, on the term sheets, right? So that's the downside risk, right? The upside to the investor is you get the yield by selling the puts, right? You get the premium,
Mhm.
and also the auto-callable part of the product name refers to the fact that if you there's a limit to how much well basically is this you sell the puts at a fixed level, right?
Mhm.
the strict fixed strike level, right? Now those puts will become quite worthless, right? If the stock market keeps going up, right?
Yeah, yeah.
So and if you sell, if you then you can't monetize the yield anymore, right? Because the options are worthless. Nobody would buy them from you, right?
Yeah.
So what they have to do is reset the whole product, when the market goes up. So there's something called auto call feature,
Hmm.
right? So let's say the market goes up by 10%, and they say like your note is called, right? We give back your principal, right? And then you just
Yeah.
have to buy a new one again, right? To reset the strike level of the down in the put is the instruct that the investor is implicitly selling, right? And then get more yield out of it, right? And so every time, so what the banks like is that every time this happens, right, the bankers collect more fees because it's a new product.
Uh-huh. Okay. Yeah, yeah, yeah.
So this is a money making machine that the basically all the wealth management the wealth management divisions of the global investment banks around the world, make their money on.
Oh, okay.
So now, so you go back to the question of like what the innovations come from. I mean, the structure is basically this, right? Now there is one which I call like really like just fluff innovation, which is like let's just change the formulas a little, right? And it doesn't really affect it. It's not really affecting the risk or anything. I mean, now the honest way of putting this, and this is one of the things that I don't like working in that business at all, right? Just it's very not satisfactory from a sort of like an ethical perspective. Is that you're making the product sort of complicated and complex and sort of obscure, right? Just to make it hard for the investor to compare products. In this form, product A from this company has a slightly different formula from product B from this company, right? Well, and they have a different price. Well, which one's better, right? Well, a mom and pop investor would know. So that's one kind of innovation, right?
Okay.
Um, so there's the other kind of innovation where I mean there's some value into it, which is like maybe you pick a more optimal schedule for you know a more optimal schedule for like the auto calls, resetting the puts and so forth, right? And I mean that, but that's still kind of marginal. And I think the big reason is that these now on the sell side, right? When we're selling these products, we don't really do asset allocation, and I think that's really like actually if you get asset allocation right, you're basically a hedge fund. You should be earning hedge fund returns that you don't get. You're obviously not going to get that from a consumer product, right? But
Yeah.
I mean that's actually so that's my personal interest of mine. So let's put that. And then but I mean I've been at the bank of work that we tried doing asset allocation, right? So now this goes into the so like, well, how do you determine like what assets to invest in and so forth? And the way those work is, well, it's sort of like technical analysis, but they don't call it that, right? When you're facing a consumer, making a consumer product, oh, that's so low brow, right? Technical analysis that just for like, small time traders like us use
Yeah.
that, right? So, but I mean, but basically it runs off like stuff like momentum, um, um, moving averages, that kind of thing, right? And it determines like how much you invest in, um, how much leverage you have implicit in the product, right? So that's basically the kind of innovation that goes on in the sell side, right? I mean, if you're talking about buy side, it's a whole different.
Okay. So you still, somehow, at least some part of it, you rely on technical analysis to, for ideation phase, and you then go on to build on strategies, right?
Yeah, so you back test it. So you back test it. You have a except I think there's if you actually interview at a hedge fund, everybody says like you give them a back test. Well, people don't believe your back tests, right? They believe in your actual performance. So there's a limited value in this,
Uh-huh.
right? It's really marketing material. Oh, the back test shows that our strategy outperformed, blah blah blah, right? Well, I mean and then after it's okay. So the idea, for the sell side, right? If you are pitching products to consumers, right? Retail consumers, right?
Hmm.
It's not really that your consumers aren't sophisticated generally, so it's not really that sort of precise and demanding in terms of your product performance and your back tests, right? Is something that looks good, then it's something you can sell, so or try to sell anyway. So that's basically that has how the idea generation works, right? You come up with something, maybe based on technical analysis, some sort of like back test, make it work, right? And then basically, the most of the innovation, in fact, is more like a marketing based. If you're talking about a consumer
Oh,
retail product,
okay.
that's why.
Uh-huh. Uh-huh.
Now I do now. There's we also did have at the bank I worked at, we did have a institutional client business, right? But again, this is not about like hedge funds do their own trading, right? They do their own like strategies and stuff. They don't really rely on us to come up with the strategy, right? Um, but institutional clients, and I'm talking about stuff, people like pension funds and stuff, right? They allocate capital, right? Say, let's put 1% of this in this strategy, 1% in that. It's like a diversified portfolio, right? And and what the bank uh would offer, the value is that, like, a lot of these pension, we talk about like let's say like pension funds of like states in the US.
Mm-hmm.
So they are some of the states are have the pension funds are really could be fairly small, from a because like you are one of 50 states, right? And you might be one of the smaller states,
Yeah.
right? And just they don't have a lot of capacity to have the infrastructure to do their own strategy, right?
Mhm.
Everything, right?
Yeah.
So they might have like some high level idea of what the portfolio manager could do, right? Would want to do at the pension fund, right? There are
Mhm.
some general idea, but they don't have the sophisticated enough tech
Mhm. Yeah.
to execute this precisely every day, right? So they outsource that to the bank, right? And so we will work with clients to say, hey, this is the strategy that they want, and then we build the, so it's more driven by the client in this case, right? And then we build, the back test, show them, hey, these are the results of your strategy, and then if they like it, then we'll implement it, build the trading systems and stuff to make it work.
Oh, okay. Awesome, awesome. So how do you find when, a strategy, is it when it stops working?
Well, this is one of the $1 million questions, right?
Uh-huh.
Uh, I mean, if you've done any sort of trading for a while with technical analysis, of course, uh, you'll find that technical analysis sometimes doesn't work, right? And in fact, I think probably most of the time it doesn't work. So
Yeah,
I'm not
yeah,
really
it's
a
true.
believer in that. All
Yes.
right. Um, I think there's the mark probably like this is you shouldn't think of the market as some sort of like environment, right? It has changed. Market structure has changed,
Mm-hmm.
a
Yeah.
lot,
Yeah.
right? And stuff that used to work, right, would not work anymore, or it doesn't work as well, right? So back to your question, how do you know when something doesn't work? Well, I mean, you just have to take losses. I think the real, I think the one of the most important things to grasp, as a trader, right, is to take small losses. Understand that you'll never be, 100% right. In fact, I think the stats that I've heard is like, even the best hedge funds like are only like maybe like 55% right on their trades.
Mm-hmm.
So I don't and the key is that like you have to watch it, in today's market, you have to watch every single one of trades if it doesn't work. If it starts not working, right, then don't bag hold it, right? Just get out of it, right? And if you do and then can consistently do this over time, right? Then you get a higher than 50% chance of winning. So that accumulates and you accumulate PNL.
Okay. Yeah, awesome. So
So
I was
you ride your winners. You ride your winners, right? The stuff that works, right? You put more capital into it, right?
yeah.
And the stuff that doesn't work, right? You keep decreasing your capital and you also ultimately you get rid of it, right? So if you do this, if you manage to do this consistently over time, you make money.
Okay, yeah, got it. So I was reading about this, this uncorrelation of strategies. So how do
Yeah.
you, exactly find the sweet spot between all the strategies that you combine, like so it maximizes returns? Like what kind of, portfolio of algorithms do you have like for algo traders or retail algo traders, would you suggest?
So now I don't do what's probably what you like traditionally call algo trading.
Uh-huh.
So that's like okay, well, you basically like code an AP, connect to the broker's API, watch the ticks and then like depending on the history and where the tick goes up and down, you buy or sell and stuff like that. I don't do I think that's one is now I haven't really tried it for so
Mhm.
you should take everything I say with a grain of salt, right? And your audience too. I mean, I'm just one trader out of many, right?
Yeah,
And I haven't seriously tried algo trading, right? And the reason is like my reasoning is this: like the competition is so high, everybody's doing it,
yeah,
right? And you frequently trade, right? So your trading costs gonna matter, right? So I don't think I'm gonna be really competitive in that, right? So I don't really do that, right? Now, as to how what's my strategy then is I do something like what might be called like macro sensitive capital allocation, right? And
uh,
I think this is something that probably only the top hedge funds will be able to do this,
uh-huh.
right?
What does that mean?
Uh, at least I mean at least from what I've understand from just sort of like general knowledge of like how people, how different institutions trade and how different invest. I think that's sort of like it's something that's I would say it's something that's just has to do with how the market's changed over like the past 10 to 20 years, right? The
Mhm.
market's a lot more reactive, right? Like sort of like in the old school way of investing, right? And this goes back to, I guess, like everybody's favorite investor, Warren Buffett, right? And
Yeah,
it's just like it's fundamental analysis. Like you sit in a room, read all these uh um earnings reports and stuff and maybe do your own research and somehow like you are so smart you come up with a new stock idea and put all your capital or could substantial capital into it, right? He's Buffett is really into
hmm,
has been into like concentrated focused investing, right? So that's a lot of how basically the thinking still of many portfolio managers traditionally, right? And you'll find them in pension funds and stuff and they have investment committees that where every month they're going to change, they're going to decide on which companies to invest or which asset classes to invest, right? And it's not very reactive. It's sort of like at least like not reactive to this on the scale that markets react today, right? Which is like daily, right? Powell says something, that's slightly hawkish and the market tanks, right? That's kind of so this is sort of like the traditional mindset is a lot more is more slower moving, right? Um and um and I think in today's world, they just don't do as well. I mean, I think that's, people don't like to talk about it because nobody likes to talk when they're losing, right? But probably a lot of underperforming funds, right? I like that, right? And you see this again. People don't like to talk about this, but I think it's you read between the lines, and I think understand like a lot of industry is like this because like if you look at just like mutual funds, right? They have been like the market share of mutual funds have been going downhill for like 10, 20 years, right? Everybody's going to ETFs, right? Doing the active trading, right? And then we have active uh, trading, actively trading ETFs, right? And the ETFs could also be actively managed, right? You have dynamic beta, smart beta, right? And
Mhm.
all this stuff. And they're taking massive market share from these all these traditional funds, right? Which I mean can only, if these funds were really performing well, right? Then they wouldn't be losing market share, but they are. So that tells you like probably like, and just like if not the majority, then a substantial number of portfolio managers actually underperform. So, and I think the reason is like the market has really changed under them. You can't just like decide on your asset allocation every month, right? Have a run an investment committee, right? You have to like actively manage your exposures to different asset classes like every day. That's what I do,
Yeah.
right? Um, now this gets into AI, which I'm sure you have questions on.
Yeah.
So that's a segue, like, later in this interview. So back to like where I was. Just yes. So the macro aware investing is like you have to watch like every move in different asset classes, right? Try
Mhm.
to figure out where different asset classes are going, right? And put your capital towards that.
Okay. Makes sense. Makes sense. So, I mean, how do you have to be a genius to, break into quant?
I if you are south side quant, yes. Well, I mean genius to a lot. I'm not genius by any means,
Yeah.
right? The reason why I went into finance in the first place was like I studied I studied computer science and pure math as an undergrad, right? And I knew my pure math ability was didn't cut it for graduate school, right? So I quit I learned, I think I do understand like I can read a math paper from a graduate math paper and understand it, right? But
Mhm.
I'm not at the level where I can do original research in math. So not genius at that level.
Yeah. Okay. So there's so as a quant, you in your day-to-day tasks, you use a lot of, ML algorithms and, a lot of bunch of AI. So, what are the top
Actually,
three or something?
I think you think so. But I
Uh-huh.
think probably, and this because I think probably only the top hedge funds do.
Uh-huh. Okay.
Um, like I mean, sure, everybody like there's I know like pension funds will do like one of the example of AI, right? They might do like sentiment analysis, right? You know, uh, grab all this like tweets from Twitter, well now called X, right? And then analyze the feed all those messages into an AI model and see and tell is it bullish on this or that, right? So I think that people do that, right? And that's a really common technique, right? Sentiment and that kind of thing, right? And I'm sure there are people that try to do like machine learning on like try to improve on technical analysis by analyzing a whole time series and stuff like that. Um, but doing it on a cross asset level, I think it feels like, just from the behavior of markets, right? I don't have direct evidence of this, that only the top players do it because I think the market's so surprised by everything, right? I mean, even like I subscribe to hedge fund research, right? And I mean, I think there are certain circumstances where I know I have an edge, and that actually did happen. So like I put on a relatively large position and I make money, and then that's the trade for a day, right? And the markets are surprised at this outcome, right? And that's why I make money, right? And the fact that this surprise is occurring means like the majority of participants aren't doing what I'm doing, or what the sophisticated players are doing, right?
Yeah.
So I mean there are well-known stories like was it Bill Ackman or somebody like during when just before the pandemic hit, right? He bought some puts on CDS or whatever, right? And he makes massive pile of money, right?
Yeah.
while everybody's well, most people were oblivious, and then so the stock market down tanked by like 35%, right? So I mean, the fact that that would happen means a majority of people were caught off guard, right? So they were doing what the sophisticated players were doing.
Yeah, yeah. So, so when I, actually trade in the markets, I usually find an edge. I think the market might have a higher chance of doing this than that. So I try to code it into a strategy, and I backtest it usually. And I was thinking, like, at what point, like, really machine learning I can apply, like. So you're saying even if we apply machine learning, there will be tail risks and market.
Yeah, that is of course.
Yeah.
So I mean, one of the annoying things that I've been hit with
Uh-huh.
in terms of like kind of like not tail, not completely off the chart, but sort of like something that was unexpected, which was and I've been hit with this in my trading multiple times. And I learned my lesson on it, right? Which is everybody is often like because there's the momentum factor. So about factor investing, right? That's what people talk.
Yeah, yeah,
That's the language that right. So you'd invest in like this portfolio of stocks, if they are like high momentum or high beta, or maybe it's like high dividend yield or whatever, right? And that's people how people allocate, right? And a lot of institutional clients and hedge funds are long momentum, right? Because it usually works. It does usually work. All the tech stocks, right?
yeah,
They keep going up. They usually go up, right? And they go up dramatically, right? Especially since the pandemic, right? But I think even you can make it. I think since 2015, if you're that's my impression of it, right? And there are structural reasons why that is, right? Why tech stocks are outperform, right? But from the machine's point of view, right? These algorithms point of view, they look at momentum, it works, it keeps working, so they invest more in it, right? But then inevitably there's a reversal, right? And it's not because, and reversal is not because like, oh, the economy is doing bad and everybody's selling side. It's not that. It's something that in fact, it's because the economy is good, right? Then people rush into like buying into the garbage stocks, right?
yeah,
Because they have been so oversold, so they reallocate, right? And then so now people, the amount of leverage might be fixed or relatively fixed, right? So that means they have to sell, the high momentum stocks and buy the garbage stock, and everybody does this, right? So and then you see, the tech stocks like drop like by like 3-4% for like no reason apparently. Well, even though the economy is doing good and whatever, but it's because of the positioning. So that's something that a lot of people don't. I mean, just the fact that everybody does it at a panic sells tech stocks at the same time, right? Tells you, people aren't taking those risks into account.
yeah. I get it. So, how much do you think like the AGI is going to change the stock market and people view how people trade?
So, well, I think AGI is quite far away, right?
Um,
But I don't think so. I don't think AGI is doing it. I
mhm,
think we are. I think AI. I think the potential of AI, like just the current level of technology, just
mhm.
speaking about the current level of our AI technology, I think we don't. I think most people really don't even take full advantage of it,
Yeah.
right? So, I think if there's a day when sort of like this is sort of like common knowledge, then of course the returns will go away and there will be,
Yeah.
and then you have to try something new. But we are not at that stage yet. So I think if you are interested in AI and deep and can develop good techniques, I think there's still excess returns
So,
that you can make.
yeah, great. So, what would you recommend for discretionary algo trader like us at the retail levels to improve their quantitative knowledge so they can apply their strategies? Do you recommend any books or resources? Any methods you can work on?
Well, honestly, I don't find like again, like I don't do like traditional algo trading, right? So uh, and then obviously the strategies that actually work. I mean, people would keep them proprietary, right? They don't want to give away those excess returns. So, you don't really expect to find good strategies out of books, right?
Yeah.
It's something you have to experiment. And I've done like trading for serious trading for like almost 2 years, right? And I watch the market every day, and I think there's some things you learn. I think as a hint to your audience, I think cross assets sort of correlations and sort of relations are an underexplored area,
Oh.
and because it's hard,
Mm-hmm.
you
Yeah.
know, if people think about like, and you apply some sort of AI technique to this time, let's say a single stock, right? Or maybe an index, let's say NASDAQ, right? It's still sort of like traditional analysis, technical analysis extended to this AI framework, whatever it is. What you really got to look at, how different assets trade together, right? Because that way, like let's say you try to understand, let's say, the signal that's implied by the combined movements of, let's say, like Nvidia and Microsoft or whatever, right? Or a basket of tech stock. And the reason why you want to do that is you want to discover what the other players in the market are doing. I mean, I think of the mark, to be a successful trader. I think you have to think of it as like a sports game, right? There's no right or wrong, right? It's not like, oh, team A wins or team B wins. I mean, there's no moral ethical dimension associated with that, right? It's just a game, like, this team is better, for this game, and or this other team, got lucky and won the game, right? Or whatever, right? And and you have different, except the market is that you have many different players, right? And you can't really see, the trades are anonymized, right? You can't see who's doing what, right? You can only guess on what people are thinking,
Yeah.
right? And I think there's signal that's embedded in the relations between how different assets trade, right? It's obviously not an obvious signal, right? If it was obvious, everybody would figure it out,
Yeah.
right?
Sure.
And the dimensionality of the problem is so large, right? Because it's not just across time, right? If you're, and I'm when let's say like intraday, if you talk about like intraday, right? And just to make sure, like even a lot of pension funds, right? They just look at, for their basic strategies, they often look at end of day, right? Because the end of day prices are more reliable and so forth, and so there are players that are not really sophisticated. So
True.
if you go intraday, that's already at least one step above the worst players in the market. So if you look at intraday, let's say like 5 minute bars, right? So what? That's what, like 12 bars per hour, and you have like about 8 hours, so about like 100 bars per day.
Yeah, Steven, just
100
like,
bars a
sorry
day, and
for
then
cutting.
let's say you
Yeah.
look back for a year, right? So that's like 365, well,
Yeah.
260,000, right? So that's for one. Yeah.
Yeah.
Okay. So we've got back to where we got time series. Let's say if you look back a year, right? That's like that's like 25,000 bars, for one asset, right?
Yeah.
And now you got like, I don't know, I think there are like 5,000 stocks on the stock exchange or something. I don't, let's make it 10,000. The So like that, you just blown up your dimensionality by 10,000, right? And then that's not counting the ETFs, right? And there are more ETFs than stocks.
Yeah.
And this is not counting worldwide stocks, right? So you've blown up the problem, dimensionality of the problem by $1 million. But yeah, I think this is where the actual signals are,
Mm-hmm. Okay.
right? It's hard. It's hard to, you know, it's hard to just wrap your head around this problem. But I think, if you want the good returns, I think that's where the innovation is gonna come in.
Yeah, true, true.
And a lot of people, if they don't have the sophistication, a lot of people don't have the sophistication yet to do that,
Yeah.
then that's our chance.
Yeah. Will they be able to, analyze, the cross assets like with AI, with ChatGPT and stuff, they can code and, correlate it, find the relationships between them. Would they be able to do that? Like, would that
I think really like, I don't think you really need like, here's back to, you asked about AGI, right? So I don't think you really need AGI
uh-huh.
to do. You really need like maybe like more classic machine learning, which is something like, that you can learn, the basics,
Yeah.
the sort of like tech basics you can learn from books for sure. Right.
Yeah.
And so that is very democratic, right? So you just have to apply them to a bigger problem than what most people have done.
So, um, okay. So, what resources or books do you recommend for people who want to pursue and quant, learn the basic programming skills to apply in trading?
So I mean, the Python's really hot for all this like AI, right?
Hmm.
It's easy to get your hands into, right?
Yeah.
And the tools are well supported, right? All the data scientists are using them. And even before AI, right? It was very popular for data science, right? And that's why it got very popular for AI, right? Because all the researchers were using. So it won't hurt to learn Python. Python is not my favorite language, however. I mean, I used it. I think I'm really reasonably expert at it. It's just that really the dynamic typing, if I may get a little technical here, dynamic type nature of the language and the single threaded nature of the language really drives me up the wall.
Yeah.
I mean, there are efforts to fix it, right? You can, there's Python, the newer Python really latest versions of Python, they're experimenting with multi-threaded, having isolated interpreters that run on different threads, and that will eliminate some of the problems there. But I think it's still sort of a very very hacky solution. I mean, if you're using Python, you probably don't have a choice anyway. I won't get into what the alternatives are because I don't know what the alternatives are. One thing, one I'm by the way, like I studied computer science and a lot of the work I did at the Southside Bank I worked at was a lot of programming, right?
Yeah.
So I've done C++ programming and I've done C# programming.
Okay.
So there's probably C++ is probably unless you're really into like high performance algos, that's probably too much of a stretch to try to learn. Rust is a newcomer, and maybe you want to learn that instead,
Hmm.
right? C sharp not really that popular, right? Even though I think, and there's a lot of history behind that because it's Microsoft. It used to be Windows only, and a lot of researchers use like Linux, and so. But I think but it has potential. That's something I'm investigating personally, right? To me, if it, it's just the ecosystem in .NET is just not as deep as Python. These kind of AI and machine learning and stuff. So that's the disadvantage for sure. Right. So probably I would for beginners who wouldn't know, you don't know where to start, I would still recommend Python because just that's
Yeah.
where everybody going.
Yeah.
You can't go wrong with that, right? And you can always like level up and use another language sufficient. What else? What other learning some math. I think learning calculus and linear algebra and probability theory is helpful. Fortunately I studied like this sort of like honors math level.
Hmm.
So when I was in undergrad, I learned like real analysis, right? That's what like rigorous version of calculus, like right. That's my first year, right? With all the proofs and everything,
Yeah.
right? And linear algebra, I studied all the proofs, right? From the book, abstract linear, what do you call it? Like abstract linear vector spaces, right? So I think that's actually helpful. right? A lot of like math courses designed for like, let's say engineer. They will teach you like the formulas and how to apply these techniques. And I mean if you get by that, I mean that's fine, right? I have nothing against, if those courses, if that level of math works for you, all power to you, right? But if you want to understand like how so like read more deeper papers in the field, right? Just to understand like how do like function approximations work in machine learning, right? And so I think you probably want to have a background in in more rigorous calculus and linear algebra, right? Um, and you can find like use standard university textbooks that aim at honors students, and if you are good, if you are self-motivated very good, you can learn that math, right, from reading
Yeah.
those books. It'll be a long slog.
Yeah.
I'll grant you that. So, and that's not for everybody, right? But if you want to level up your math, right? If let's say you studied math in college and it didn't click for you, right? And this is, I think, a common story, right? You learn all these formulas, you didn't really understand where they come from, right? And you find them hard to remember, where is this, and it seems all arbitrary, then maybe so a more foundational level might somebody like that, right?
Yeah.
That's more that depends on the person.